Hello and welcome once again to the Duke William online teaching platform. In this session, I'll be looking at a more basic investment appraisal exercise, working with the spreadsheet tool. Essentially, that's the main reason why we're doing this, so that students can have some understanding on how this tool can help them work out answers from this bit. So let's start right away by looking at this question on the left side of the screen, which says review company is considering project alpha and the project cash flows as follows. As you can see there, it does have an initial investment, very important, a scrap value or residual value of 10,000. Project duration, 5 years, very, very important so that we know the number of years. Forecast sales and volumes over the next 5 years is as follows. So these are volumes or units to be sold. Now, typical of any exam technique, usually after reading this, and that you would want to read the requirement, but I just want to go through this one quickly. Um, Selling price is estimated to be 8 per unit, but notably, it says that will happen in year one. So it means that growth will start from year two and it will grow by 5% per annum. Interesting. Variable cost, it says currently means that in today's money, that is at time zero, is stated at 4, and that would also increase by 4% per annum for the next 5 years. Then fixed cost associated with the project expected to be 6,000 in year one. So just like the sales, increasing by 4% thereafter. Very interesting. It says at the beginning of each year, the company will need to provide a working capital of 20% of anticipated sales revenue for the year. So working capital, we need to work it out of that. And then any remaining working capital will be released at the end of the project life. That is also noted. Then tax, it says corporation tax is payable at 30%. That's our tax rate. But interestingly, it said it's paid in the same year as the profits are earned, meaning that our schedule for the NPV will end at year 5 because it's not paid in 1 year in arrears. Um, Tax allowable depreciation is available on the initial investment of 100,000 at 25% per annum on reducing balance basis. So that is what we have. So these are typical elements in a standard NPV question that we're going to use the spreadsheet to help us work this out. Then the first requirement is to calculate the NPV of the project if the nominal post-tax cost of capital is 10%. So yes, estimate the IRR of the project and the internal rate of what return, we know that one. And then C, to calculate the percentage change in the selling price required for the project to have a zero net present value. So here we are talking about the risk-based, so sensitivity analysis here. And then to work out, calculate the project duration and the modified internal rate of return. The requirements D and E will be suitable for candidates writing advanced financial management, but then the first A, B, and C will be examined in financial management or the FM paper. So this um, is okay for both students preparing for both papers, except for the D and E, which will be a requirement under the advanced financial management. So what do we do? Now, what you need to do here is to have an idea of which cash flow goes where, or to have a good understanding of the cash flow pattern in a typical NPV schedule. So if you look here, I've written must know in the sense that these are things you ought to be able to, sort of work your way around to see. Now, a typical NPV goes with the years on top there, followed by the signage for the currency, then revenue, then any, direct cost. So if you have material, fair enough. If you have labor, fair enough. other direct costs, or it could simply be just variable costs in the case of what we have here. And then we knock out the tax allowable depreciation, and then we pay tax, and then we add back the tax allowable depreciation. So this is taken out and added back. So in this schedule, we are not doing tax relief on capital allowances. So then the initial capital, the resale value or the scrap value, and then we get a net cash flow post-tax discount factor giving us 10% the present value NPV. So this schedule is so important that we need to have our head round. So I want to start by yes, looking at this question called review company. Very interesting stuff there. So I can start by looking at the years. Okay, so the years you do that, tidy up, finish nicely. One, two, three, four, and then five. So you have the years there. So then I could also put in the currency there, very, just drag it there. You can decide to, vent it or whatever it is. It doesn't really matter. Then all I need to do is to now, having read through the question, I can see there is sales. So there's going to be, sales revenue. You type that in nicely, and then you have, I can see variable costs. I can also see fixed costs. Then nothing else. I think I can see tax allowable depreciation going out there, and then nothing else. Now, what you need to understand is in the ACCA schedule, that you cannot insert a cell or introduce something in case maybe I ought to have put fixed cost there and I missed it. So in that case, you simply have to Control X, cut it, and then paste it on the next line, and then you can find a space to insert anything that you missed. So take note of that. You cannot insert, a space or a cell in there. So where you miss something, you just have to cut and put it one step down. So looking at the schedule, we look at from that bit, we have taxable profits, the tax, and then we add back that and so on and so forth. So it is something you need to get your head around. So taxable profit, then tax at 30%, then I can add back tax allowable depreciation, and then work out the initial. It's important you do this before you start any calculations. Initial residual value or scrap, if you want to call it that way, and then you have working capital. Now, all the sales and revenue, variable cost, and all that will be done through workings, and we'll be referencing and coming back to those sales and telling the marker where, which workings we need to be referring to, and so on and so forth. So, from here, we can have a net cash flow, then we can have the discount factor. I'm not sure whether we need it. Maybe we do, but then just as a matter of principle, so we work out the present value, and then from there we can get our net present value. Very interesting. So you could pause and at this point to see if you are in the position to do that quickly. So an outline of what the answer should look like is what you ought to do. And if for those doing advanced financial management, if you have to do an overseas investment appraisal, you would need to come out with a standard, understand the standard and know who goes where, come out with a schedule, and then begin your work. All right, so looking at this, um, I would want to begin by uh, doing some workings here for the sales and stuff like that. Now, also, what I could do is, in order to keep everything in shape and stuff, I could decide to format all my cells so that they all give me two decimal places maximum if I want. So I could go here and say I want that as a number, two decimal places maximum, and then so anything in there will be tidied up within two decimal places. So um, you can do that and format the cells in there as well. So yes, for these workings, I could introduce again the years, maybe one, two, um, three, 4, 5. Okay, so if I look at the sales volumes, I'm copying from there. I can see that from here, 10,000. So yeah, 10,000. I'm looking at 10,500, 10,200. Then I have 10,100. Then you look at 9,000 there. Okay, so I want to work out the sales revenue. So sales revenue, okay, and I'll probably want to call it sales revenue. I would want to call it working one. So it means that I can go here and then reference this as working one. Just to tell the marker, if it needs to find out how I arrive at the figures here, it needs to come here and see that. Now, what do I do? Now, interesting, let's go back to that point. It says selling price is expected to be 8 per unit in year one. So it means that year one, it will remain 8, and then starting from year two, it will grow by 5%. So what I could do here is, of course, every formula begins with an equal sign. I take the units, I'm multiplying this by 8, and I'm multiplying it by, I could have just done 8, but I know every number raised to the power 0 is equal to 1. Whatever you raise to the power 0 is equal to 1. So I'm going to do 1, and I'm adding on the 5%. I can see 5%. So it's going to be 1.05, which is the 5%. Then I'm raising to the power, so shift 6, and watch carefully. I'm raising it to the power 1, but then once I drag it, it will take the rest so that the growth will actually begin from year 2. So notice that because the selling price is 8 in year 1, I'm raising it to the power 0. Okay, so once I have that figure, and then I can literally just do this here. All right, now once I've done this, I won't waste time. I'm going all the way straight up here to say I'm pushing that in. So look at that. I put equal sign there. All I need to do is to reference the first one, and then I'll just drag the rest back in, and I have those figures there. So if the marker needs to see what I've done here, once he comes here, I'll need to come to workings one to see how I have arrived at those figures. Very, very, very interesting. Very, very interesting. Okay, so the next thing on that line, if I want to call this, say, working two, it's important that the marker has an understanding of where the figures are coming from. So I can say variable cost. Okay, so that is my working number two. And so again, I come variable cost. I'm told this time it is 4 per unit is currently, meaning that in today's money, That is that. So I take the units. This time I multiply by 4, and I'm multiplying by 1.04 percent. Okay, but then I'm raising that to the power of the number of years there, because it is currently 4. So then that gives me 416. Now this is it. So yes, this is where I got that from. Now I have a choice to represent this as negative here, or leave it as positive there and then reference it as negative when I'm adding up. But I would want to do it negative to start with. So equal to negative. So watch, I'm doing equal to negative because it's going out of this figure. Once I put that there, again, all I need to do is to drag it there, and beautifully, I do have all that there. Very, very beautiful. Very, very nice. Okay, so fixed cost. Now, with things like the fixed cost, I don't necessarily need to show workings. I Because it's not related to the volumes, I can literally just put the fixed cost in there. It's expected to be 6,000 again in year one, just like the sales, increasing by 4% thereafter. So what I'm going to do equal to, because I'm subtracting negative, so subtracting this, I'm doing 6,000 multiplied by into bracket 1.04. Again, because that is in that starts from year 2, I'm going to reference that to this, and I have negative 6,000, and I can literally just do this, and there I go. I have those figures there beautifully. So the next thing I need now is my tax allowable depreciation. Now, before I do that, I just want to demonstrate this, call it on pen and paper, so that you can see where I'm getting those figures from. So again, I would want to do this, say, yes, tax allowable depreciation, but then I would want you to understand it from how I've arrived at those figures, then it can make sense. So you do have um, the year, um, the cost or the investment, and then you do have 25% written down allowance, and then the year. So 1, 2, 3, 4, 5. Okay, so it costs 100,000. 25% is going to be 25 in the same year. So 2, 3, 4, 5. Now, this is what you must remember, that the total written down allowance is always equal to the initial less the scrap value. So in that case, if initial is 100, I'm taking out 90, sorry, I'm taking out 10,000 to arrive at 90. So then I do have 90,000 here. Now, what you need to understand is, because it's 25% uh, reducing balance, then it means that in the following year, this balance is going to be 75% of the previous year's balance. So then that will give me 1875. And then year 3 is going to be 75% of 1875, and that is going to give me 14062.5. Then this is going to be 75% of 14062. But you don't need to do this. But don't forget that in the final year, you don't claim capital allowance. So this would always be the balancing figure. And if it's the balancing figure, then it means that, for example, if I do have 10, 5, 4, 6 point something there, then the difference, if I add all these ones, take it from the 90, will give me the figure that sits here. So if you can understand this, don't forget, I'm not doing tax relief on capital allowances. For those of you doing FM, that is not what I'm doing. I'm using taking out the tax allowable. It says allowable depreciation. So I'm treating it as an expense, but then no physical money is leaving the business. So once I pay the tax, I'll add back that. So let's see how this turns out here. So I would want to, the initial capital I have here is equal to negative 100,000. So that goes there. And I want to reference that in this working. So I'm going to put here. Now you notice that it is already negative here, but I want to reference it as positive. So equal to negative of this, and that gives me so that it can help me work out what I need. Okay, so in year one, my tax written down value, you saw that to be 25%. So this is simply going to be 0.25, okay, multiplied by this, and that gives me this. So 25,000. So this then will now be equal to 75%, because 25% will be left 75% previous year's balance, multiplied by this, and that gives me this. And once I've done that, I can drag this to the fourth year. So I can see those figures here, knowing that in the fifth year, it's a different ball game. Now, in the fifth year, as you can see from here, you notice that I had my 90, and my 90 comes from initial take away the scrap. So I'm going to fix that in the formula. Then the balance for year 5 will simply be 90 minus the sum of 25,000 plus the sum of 18,750 plus the sum of 14,062 plus the sum of 1054.8. So then I can get that figure there sitting there. So let's um, look at that. So to get this, watch carefully. I'm going to do is this bit is going to be equal to, first I have this take away 10,000, which gives me the 90. Then I subtract the sum of all these figures from that. Oops, I'm missing something. Yeah, the sum of all this to that. I think something is missing. Okay, let me just go back and do that. So I'm doing 90,000. Let me just do the, I think I'm missing something. So I can put a bracket here, a bracket there. Just bear with me. I'm missing something. Let me just clean it out. I'm doing 100,000. Okay. Um, I can put that in bracket just to be safe. Knock out 10,000, and that gives me 90. And once I have that figure, I minus the sum of all the figures from here to that, and that should give me, yes, I have it. Yeah, that's it. So anybody, or if the markup picks that, he can see from this formula window how I have arrived at that figure. Okay. Oh, wow. Okay. So how I've arrived, it's important that they can see from here. They should be able to see so that they know where you are going right or wrong. So again, these are negative cash flows. So equal to negative of, so I'm taking that out, that, and once I can find it, I'm pushing that out there, and they are all negative. But don't forget here it will be positive. So I'm simply going to reference that, and I have that here as well. So this then becomes my working frame. Okay, so I tell the marker where all that is coming from. Now, so at this point, as you can see, I can get my taxable profit residual. Don't forget that one, very easy, 10,000. Then I can work out my working capital. Now, very interesting. I would want you to pay very good attention to the working capital. It says at the beginning of each year, um, the company would need to provide, it says at the beginning of each year, meaning that the investment in working capital would have to start at the beginning of year one is the same as the end of year zero. So the timing for working capital is the same as the timing for the initial investment. Now, so what do we do? I'm going to look out for the working capital bit there. Very interesting. I want you to pay attention. So 25% of the sales, or 20%, I'm told, my apologies. So 0.2 multiplied by this sale. So I only need to do one, and the rest will just follow up like that. Very, very interesting. So that is that. But then I will need to understand the working capital cash flow, the working capital cash flow. This is important. Okay, so then I say in year one, this is going to be the negative of this, and that comes to that. Okay, then from year um, two onwards, you see, this is we need 16,000 in year one to do business. We need 17,640. But don't forget that 17,640 is made up of the 16,000 we have already invested. So an extra 1,640 is what is needed. So all I need to do is when I come here, I'm going to be looking at negative of this figure and take away that figure, close it. Okay, so once I have it, and I can drag this again all the way to that point. Then at the end of the day, the total I've invested is 16,000 year one, extra 1,640, extra 35.2714. And you see, given that in the final year, the total I needed was less than that which I invested in year four, you notice that it becomes positive here, showing that money has to be released. So at the end of the day, the total or the final figure in year five should be 17,503. So let's see. All I'm going to do is to sum up this. Okay, so I'm going to do negative the sum of all the figures that I've invested so far to date. So that gives me that. So again, you can see that these two figures are the same. So I'm now in the position to just simply reference them as working capital. So I'm going to come here and say equal to that bit there, and whatever sits there, I'm simply going to drag to the end, and that's it. So very, 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 very beautiful. In fact, all the work is done now. So let me look out for my taxable profit and tax at 30%. So I would want to underline that I've done that beautifully. Taxable profit will simply be the sum. It's so beautiful using the spreadsheet of all that, and that gives me this figure. So again, I'll simply just drag it here, and that gives me this. Now, tax is always a negative figure. So again, equal to negative zero point 0.3 multiplied by one of these, and I do have this sitting there as negative. So beautiful. You can see that there, all done. So let's just tidy it up with getting the net cash flow. So the net cash flow will simply be all figures from the taxable profit, all of them down to the working capital. So yes, so I'll do equal to the sum of this, and look at where I'm referencing from the taxable bits. I know there's nothing there as far as the year zero is concerned, but I've still done that and close it up. That gives me 1116. Beautiful. And I have this. So job done, really. Nothing to worry about. So discount factor, I said at 10%. That's what we're told in the question here. So all job done here. All right. Now, interestingly, I can find the NPV without having to go through using the, call it the multiplying by the discount factor and so on and so forth. So let's look at how you can find the NPV. Don't forget that the NPV formula you get in the ACCA, that formula, when you use equal to NPV, it gives you the discount factor or the discount rate, comma, and then the range of values. And what is this range? That range is always from year 1 to n. So literally, when you use the NPV function, you are effectively looking at present values from year 1 to n. And of course, you will need to knock out the initial capital for you to get the NPV. So let's look at that. Very interesting. So if I want to do this, I would want to pick up the present values from so present value from year 1 to 5, if you want. So that is what I'm going to use the NPV thing for. So I take this equal to NPV. My discount rate is 10%. So don't forget that point 1, comma. All I need to do is look at that from year 1 to 5. I reference this and close it, and that is it. But this is not the NPV. Let me stress again, this is not the NPV. So then I come with the initial capital, okay, and then I just referenced whatever figure I have here, which is this bit here, and the NPV then sits here comfortably as the sum of the two figures there. So I have this, add on that bit there, and then you have 16,773 as that. So beautiful, beautiful, beautiful. So let me just bold this and probably give it a bit of color. Yes, so that is the NPV sitting there beautifully. That's the NPV, 16,000. So you can just get your head around this. Another person could say, okay, why don't I just simply say, okay, equal to MPV, right? Of course, the discount rate. Then I reference year 1 to 5, close the bracket, and then subtract this from that. You should come to, oh, oops, let me see. What did I do wrong? Oh, I subtracted instead. So I'll add. I need to add because it's already negative. So yeah, that's the beauty of spreadsheets. I have it. So I have it. So I was subtracting because it's already negative, and I have it. So it's up to you. All that if the marker can see from this window, that yes, indeed, and that is the MPV. So that's it. That's it. Nothing to worry about at all. So it hits on it, and you should be able to tell. So make sure you are referencing every calculation, and in the window, the marker is able to see. Just in case that you miss out something, then partial marks can be given there. Now, the IRR also very, very, very interesting. I mean, this bit here, you can actually see. Let me see if I can. So yes, the IRR is simply the IRR, the values. The the guess is optional, okay. But then once you hit the values, what you need to remember is that these values should start from year zero. So literally, all that I'm trying to say here is if it is IRR, okay, all it has to do with equal to IRR, and you only specify the range, and this range will simply be year 0 to n. So I'll reference from the initial investment, which is negative, and that should be enough. So then IRR will simply be IRR, nothing to worry about. Everything here comes here beautifully, and we do have this as that. So, and that sits as a percentage. So, yeah, we can work that out as a percent, 15%. You can put them number of decimal places, or whether two decimal places or whatever you want to put that as. So very, very, very interesting there. Let me, yeah, let me keep that as red. Yeah, just to, so yes, yeah, 15% for the IRR. So you see, the A and B is answered. So I have this as my NPV 16,773, IRR as that, and that comes out beautifully. So the next C, which is where financial management students will end at, and then those doing advanced financial management can look at what is meant by modified internal rate of return, or the project duration, and so on and so forth. So it says calculate the percentage change in selling price required for the project to have a zero net present value. And obviously, this is clearly what one will refer to us as sensitivity analysis. And sensitivity analysis, there is what we calculate as sensitivity margin. And the margin is given as the NPV divided by present value of the cash flows under consideration, okay, and then multiply by obviously 100. Now, so in our case, if we can find the NPV, which we already have, divided by present value of the sales, revenue, because that is the one that is related to the selling price. So all this then multiplied by 100 should give us that. So to find the present value of the sales revenue, I want to stress this, Lord. We can simply, there are two schools of thoughts here, and for maybe financial management students, it's okay to simply find the present value of the sales without allowing for the tax. And the AFM, the examiner, has in that case said because the NPV has taken care of tax, then we should also take 75% of, of that cash flow as the present value. So you can be it could be before or after tax. So it's up to us. So let me just use after tax, because in one AFM question they've used the after tax. So but if you use before, then I don't know what the other team leader would do. But then interestingly, nothing to worry about there. Now, okay, one thing I missed here, I ought to have labeled this as a B. It's very, very important so that the marker can see where the B is and then call this A. And so let me just say this is C. Okay, so Okay, it's C. This I want it to stay as it is. I'm not asking it to do anything for. Okay, so C. Now all I need is NPV. I have the NPV. Then I need the present value of the sales revenue. I have the sales revenue. To find the present value at 10%, I just realized that if I use the NPV formula, it can give me the present value of any cash flow from year one to end. So all I'm doing here is I can literally just say my margin, okay, the after tax margin will simply be the NPV, which could be any of it. So NPV divided by, um, okay, maybe not to make things, rather complicated. Let me just take NPV. Okay, I have it here. Just keep things simple, whatever figure you have there, and then PV um, of sales. Just keep it simple there. So I'm going to do equal to NPV. The discount factor is zero point 0.1, and I'm going to reference the sales revenue. So the spreadsheets make life so easy. Okay, so I have that. Let me close it. Now, I may want to multiply this by zero point 0.7 because my tax rate is that, and that gives me this. Now, if you decide not to do that, then you don't multiply. So I can see I've done that, but then I've multiplied by zero point 0.7 because it is only fair that if the NPV was arrived at after tax, then the cash flows for consistencies. But it's okay to also leave it that way. So it's up to you. So then it means that my sensitivity margin will simply be equal to that value divided by that. Yeah. So again, I can keep that in percentage there, 7% or yeah, whatever it is there. So it means that selling prices would have to increase by 7% for MPV to be zero. Very interesting. So at this point, all candidates looking at doing FM, that is what you need to know basically at this point, and the rest are things that you can apply and get your head round. So for those needing to do um, AFM, then we can be asked to do the project duration. Project duration. Now, interestingly, duration, if you look on that, has to do with if we can find the present value of the inflows, as you can see here, then we multiply them by the number of years, weighted by the number of years, then we get weighted present values, which we already have. Okay, we have the present values, but not weighted, so we've got to weight them. Then all we need to do is this value is then divided by the present value of the inflows, which already have when we're calculating the NPV. So not by the NPV, okay, not by the NPV, by the present value of the cash inflows. So once you have an understanding of that, all we need to do here is to go and find the weighted present value. So going back to this, so because there is project duration, I'll need to put the discount factors here so that each year would have to be multiplied by a particular number of years because that cannot be factored in the NPV formula. So yes, the discount factor is 1 over 1 plus r to the power n. So I'm going to do that 1 divided by 1.1, which is 10%, raised to the power. Look at that. I'm going to raise it to the power. I'm referencing this. So that will give me 1 anyway because it's here 0. But when I stretch forth, that can give me that. I mean, for those of you thinking, what is it that we have here? You can even just for that bit, say you want 3 decimal places so that you can see those figures that you are probably familiar with already. You know these figures of 0.909 and all that. Okay, now at this point, I can actually work out the weighted you know present values by multiplying each of them by the number of years. So the weighted present values, I can do that here and say, okay, um, weighted present values. Let me call this weighted present value of the cash flows there starting from year one. So it's going to be equal to um, the year, okay, multiplied by the net cash flow, multiplied by the present value, okay, and I have that, okay, and then I only have to drag it there, and I have the rest sitting there. So yes, the year two times this times that, it follows on and on. Now it is the sum of this which I'm looking for. As you can see from here, once you've done this, the discount factor, okay, so the number of years we picked times the cash flow times the discount factor, that gave us this straight away. So I need the sum of all that, and then I can divide it by present value of the inflows. So very simple, interesting. I'm excited about what is happening here. So yes, equal to the sum of all that. So equal to the sum, um, all these figures. Interestingly, so um, that is that. Um, Let me give it a color so that you can see. And so now that I have there, I can say duration or project duration is simply that figure equal to that figure here, okay, divided by the present value of the inflows. And I have it already. That is why I did this. The present value of all the inflows were these cash flows here that I had, or simply the initial capital plus the NPV will give you the present value of the inflows. Okay, so either way, that's it. So then the duration is 3.14 years, 3.14 years. So I can just, yeah, 3.14 years. Very, very, very interesting there. So that is to do with those looking at advanced financial management. So that is recommend D and E. So then you can put this number of years there for that. Okay. So um, E finally, which is the modified internal rate of return, referencing or looking at the formula again, we can see from here that the modified internal rate of return given here has values. It says take the values, but then of course these values will be from year 0 to 1, just like the IRR. Then the finance rate, that's the discount rate. Then the reinvestment rate. Now, when you're not told how much cash inflows are reinvested at, then you assume that they will reinvest it at the cost of capital because that is consistent with the NPV assumption. So it means that we will find year 0 to 5 cash flows here. Then we use 10%, comma, another 10%, and that should simply give us that value. So then we come here and say equal to, I'm picking cash flows from year 0 to that, okay? So, comma, then 10% discount rate, comma, 10% reinvestment rate, and, oops, what did I do wrong? Okay. have to do it again. Oh, I didn't type the MIRR. So I have IRR. Yeah. Yes. Beautiful. 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 So it's all done there. Question beautifully answered. And these things come with practice. And it's important that we we practice these things and work our way around these things. So very beautiful answers. The MPV of that, IRR of this, duration of that, modified internal rate of return of that, and that's it. And that is what it is really. Nothing to worry about. So help yourself. Go through some of these things, and the speed and stuff like that will come in later.